Hey, we're joined now by one of our advisors here at Allworth, partner advisor, Mark Schoen. Mark is Mark. First of all, welcome to the program.
Thank you.
You've been an advisor in this financial services industry for 2 years, 3 years?
Yeah, 20, no, 34.
34 years.
34 on the side. Yeah, it's been
We
a
started it around the same time.
We did.
And I did.
And
like
the reason Mark's joined us is he has a lot of experience on helping, and he's kind of one of the go-to people at Allworth. When someone has a concentrated position, like you've worked for Apple for many years, the vast majority of your wealth is in Apple stock. It's done extremely well for you, but you're like, I'm getting retirement age. Like, I want to make sure that should Apple go the way of some other companies that have in the past, I want to make sure I'm diverse. How do I diversify without getting clobbered by taxes?
and we should point out that Mark lives in the San Francisco Bay Area and has lived there for many, many years, and works out
No,
of an
he's a
office.
Nevada resident.
He is a Nevada
Yes,
resident.
so the majority of his time is out of California.
That's right. But you have an office in. But most of the work you do is.
Yeah, most is in the Bay Area. Yeah, and I still spend a lot of time in the Walnut Creek office as well. Yeah.
So so you're familiar with these concentrated stock positions.
Yeah. There's a few. So I mean, all the names people that I've dealt
These
with.
are companies that have done well. So I'm guessing you're not doing a lot of people with Intel stock right now.
Not so much.
Yeah, companies that have
not a
stumbled.
lot. PG&E, not a lot there.
Yeah.
But it's the names you all know: Salesforce, Alphabet, NVIDIA, up in the Seattle area, Amazon, Oracle. I mean, it can be all over the place.
But your specialty is actually so sought out that you do a lot of this by Zoom now.
Yeah.
Right? Because like someone in our organization, so we have, I don't know, 160 advisors. I don't know. How many?
I don't know.
I don't know. Something
It's north of that now. I think it's close, pushing on 200.
Okay, 200 advisors. So if someone comes across a concentrated stock position, they go to you in the organization.
Well, we have other.
That's correct. But they're one of the go-tos that because that's a specialty of yours.
Correct.
All right. So tell us what you do.
Yeah. So, well, first of all, I think you want to start with how do these investments feed your lifestyle, right? So a lot of times people start with, there's some general rules about concentrated stock. It shouldn't be more than 20% of your portfolio, and those things are all very dry. But
and those aren't hard and fast rules, and there's debate on those.
There's debate. That's correct. And people usually, when they have these concentrated positions, there's an affection for the position. There's a lot of things to work through. So,
well, typically the reason they still have a concentrated position is because that company, and it's usually the companies they've worked for, right?
Yes.
It's the companies they worked for, and if you've worked for one of the ones you named, that's the best company ever.
Yep.
Right? And so part of you doesn't want to diversify. You haven't really yet because you didn't want to pay the taxes and because it's been doing, quote unquote, doing so well.
Yeah. Did well.
It did well.
But they say doing well.
It's doing so well.
Yeah. But the thing is, you can, if you look at it, I would say when we implement some of these strategies and you're working from a place that here's where we want to be 4 or 5 years from now. This is what we want to be. And all the time you want to root like crazy for this stock. So that's not a problem. But I think it's important to start with why is it important to do this? And I just have a couple of personal experiences with clients that I've worked through and still have, obviously. But I had a lot of clients that had Silicon Valley Bank. Silicon Valley Bank.
We all kind of forget about that now.
Yeah, very concentrated position. I mean, the go-to bank in the area.
Yeah. It was the bank.
And it's still fresh on your mind.
Oh, yeah. And so I had clients that had very concentrated positions there. And
what did that stock go to?
It went away.
Did it go zero?
Oh, no, I know. But what kind of run-up did it have?
Oh, it was the go-to. I mean, it was high double-digit returns year over year
For multiple
years. Yeah.
Until it wasn't.
And
these might have been investors in the original Silicon Valley Bank or employees?
Employees, high-level employees, some who had retired, and a majority. No, we got out. They had the courage to we did this. So when I talk about concentrated, it's not like, hey, this is some fancy portfolio thing. This allows people to stay retired.
So you had clients that you helped diversify away from that as they moved into retirement.
That's correct.
And it saved their bacon.
That is correct.
When the company blew up.
That's correct.
I imagine those clients are very fond of you.
Yeah, and they took courage on their part too, because it pays some tax and do this. I mean, it took courage. So let's, we worked together. It was great. I'm glad I had conviction, but they had conviction to be able to.
And
take
the hard
action.
part, the companies you just named, excluding Silicon Valley Bank, had someone 5 years ago said, "I'm going to diversify away from these." They might. Then the hard part is if the company stock keeps going up. You're like, well, what did I do that for?
It's very
So it's
difficult.
hard.
And that's why I always start saying, we're still going to root like crazy for this stock, right? So
because they still have a position in it.
Yeah. You can't get rid of it all, typically.
And nor do most people want to.
Right. But I'll even a different story there. So I wasn't in the investment business when I was in third grade, but I had a basketball coach from third grade to sixth grade when growing up. Great man. He's still alive. He worked for IBM. And he'd always come to basketball practice in that blue pinstripe suit.
Yeah.
I mean, everybody had it. IBM was the place. This is in the 70s.
And their red ties?
Yeah, they had red ties, but it was the blue pinstripe suit was the thing. So he came all the time. He would show up. And then one day he shows up and he's not wearing it. Found out he's retired from IBM. And a few years later, he's taking a part-time job and doing it, whatever. So obviously, he had a pretty concentrated position in IBM, and IBM, went from the thing to not. So it happens.
But by the way, Mark, you were built to be a financial advisor to recognize that by the sixth.
He's in third grade,
right?
How can I?
No, but the sixth grade
there must be a way.
No, but
This kid's trying to figure out how to get to Mars. This kid's trying to figure out how to solve cancer. You're like, there's got to be a way to protect these assets.
Yeah, that's right. No, it's just those are things that kind of live with you. So that's why I say there's portfolio construction and those things, but this is people's lives. So you have to do the right thing for folks. So a couple of the strategies, there's really strategies for people who no longer work at the company. There's a lot more leeway on what you can do there. And then there's strategies for people who are still working there.
Yeah, so give us an example, or maybe a client you worked with that in one of these top companies, looking at retiring, you've got a plan to diversify the stock.
Yeah.
Tell us some of the strategies there.
70% of their net worth, 80%.
Yeah. I mean, in some of these companies, the stock is so robust, it ends up being 70 or 80%. Right?
Yes.
So the discussions are, one client, the stock just ran away. It was, it's one of the biggest names, a little fruit company that you know about, and started having discussions around
a little fruit company.
Started having discussions about. Most of that compensation it's executive compensation. It's RSUs, employee stock purchase plan, some ISOs or incentive stock options, non-qualified, so it's a whole basket of things. And
all have a different set of rules around
That's
them.
right.
That's correct. Different taxation rules, liquidity rules, all of those things. So when somebody is working at a company like that, most of the time, some of the strategies are taken off the table. Like you can't write options on some of those positions.
You're not allowed to.
You're not allowed to do it. So the things that you do there are, as those RSUs vest, you sell all of them because there's no additional tax burden. That frees up cash that you invest outside of the company in something like direct indexing, as an example, where you can harvest a ton of capital losses while the market's going up, by the way. All right, so direct indexing, instead of buying an exchange-traded fund, you buy the shares individually. If the S&P 500 goes up 10% in a period, not all 500 companies go up. Some of them go way up. Some of them go down. You can harvest losses as they go down. So you're starting to build those losses.
And Mark, in this direct index, would you carve out technology out of the direct index?
You can do it. You can do dividend payer. All kinds of indices that you can.
So, but if I had a big concentration in this fruit company, right, in the Apple, I wouldn't. If I did a direct index, I wouldn't want to. Because Apple would be a large part of that direct index.
Exclude that out.
So you would exclude that out and maybe some lookalikes.
That's correct.
Right?
That's correct.
So that you're not doubling down on your concentration. So that's one of the values of direct indexing is that you can.
There's other strategies you could do. Single stock strategies that do something similar. But
so this is a person who's in the company. There's some issues there. So you build up capital losses. When they retire, those shares come over, and now you have some tax-free room to diversify. And once they leave, you have other strategies. So it really starts early. While you're working at a company, set the stage for cash flows, how you want the portfolio to look 5 years down the road, and start to make some of those moves.
At what age do you think someone should start diversifying out of their company stock? Because had somebody, let's say you started at Apple, let's say you're 55 today and you started at Apple when you were 25.
Yep.
And you said, I never want to have Apple be more than 10% of my portfolio or something. You're going to be relatively poor compared to all your...
Yeah. There's some envy there. So I think it's as long as you have assets, if you're building assets outside of that concentrated stock in a significant way that can support your lifestyle. So my conversations, some particularly
almost like it doesn't exist. Right?
When you're young, if things don't work out, you've got time to retool your career, whatever you need to do.
Yes.
When you're 65, you want
a little more certainty. Because you don't have time to make it up and do that kind of thing. So that's why I say you do want to run the retirement plan, but it's not, hard and fast rule. You don't want more than 10%. I mean, that's silly. And with some of these stocks, I don't care what you do, you can't avoid that because they ran away for such a long period of time.
And nothing grows forever.
Nothing grows forever. So, but the things that you do while you're working there, there's some other strategies as well that you can diversify if the shares are free and clear. Depends if the company allows lending. So there's some things that you can do there. But when you retire, you're in a much better tax position. Now you can do that and shelter a lot of capital gains tax because you've done direct indexing or done portfolio management outside, and your tax bracket's gone way down. So it really gives you a lot more leverage to.
And typically, once these people leave their employer, can they then use some sort of options to protect their positions?
Yeah.
So they could call her.
Yeah, world's your oyster there. So you're in pretty good shape. But it's not only people who work that. So there are, if you think about how people get to concentrated positions, they either they sold a business, inherited some money, and bought some of these stocks, and they have huge gains, and they think, hey, I'm stuck. Well, you're not. You're not stuck. And particularly if you don't work at the company, you're not stuck. So you can, one of the strategies, there's three things you can do, right? You can sell the stock and pay a bunch of tax. Most people don't want to do that. You can do something, historically, there's something called an exchange fund. You exchange your shares into a basket of other like people that work with different companies, and you create a diversified portfolio. These are sponsored by a number of companies.
It's a little tougher for the Magnificent Seven because they're the...
You can't... They're not accepting Apple or NVIDIA.
So they don't need it anymore.
No,
because you think of it like building a mutual fund, right? Where rather than collecting cash from a bunch of people, you collect shares.
Yes.
Well, the people... If your company's been a loser, that's not one you're looking. Right. You can sell it and take a loss. You're not going to try to put it in an exchange fund, so it's a little challenging.
Yeah, and there's lockups. There's all kinds of things. So it's that exchange fund. Not seeing that as much, particularly with tech companies. And the third thing is you can do exchange replication, that's utilizing options and collars and things, and you can exchange up to 70% of the risk of Alphabet or Amazon or any of them, 70% of the risk to an index, S&P 500, a small company index, international index. So you can exchange that risk without taxation. So you still hold the shares, and then you put option strategies around that synthetically give you that risk. You're exchanging the risk of the single concentration for a broader base
market.
You're paying a premium. You're paying a premium.
Insurance premium, essentially, right?
To put a downside, and then you're buying options in a different market.
But it's also neutral because you're doing you're doing options on the shares themselves and like the S&P as an example. So you're usually net neutral on the premium. You're just gaining the exposure.
It's just a form of collar.
Yes. That's correct. But
and we should explain. Can you explain to the listeners what a collar is?
A collar essentially is you're putting in very layman's terms, you're putting a cap on the upside participation of a stock and a cap on the downside participation.
So you're receiving a premium from someone
Yep.
because you've exchanged some upside, and then you're paying a premium to someone else, and those neutralize each other.
That's correct. That's correct.
That's what a caller
Yeah.
is.
But then there's other strategies around, if you're doing some people for like covered calls, right? So you can use the premium of selling those covered calls to pay your tax bill, to get out of the stock over 2 or 3 years. The point is there are strategies to eliminate this single stock risk, but it depends on a lot of things individually. What's the outside portfolio look like? What income sources? What bracket are you in? Yeah. So those are all.
And where do you do the options? Do you do them on the brokerage account? Do you do them in a retirement account? There's those.
You do. You usually segregate out that stock into a separate account, and then you have the options right there.
Oh, is that right?
Yeah,
it's just easier.
Well, you know what? It's easier to view. So people for a while they'd be like Apple, like, hey, how's this strategy working? So fourth quarter last year, I said it's very effective right now, but it's not efficient because Apple stock outperformed the S&P. I said, doing what it's supposed to do, but
that was last year.
That's last year.
Today,
a little different ball game. So you can put some certainty around what expectations are, but it's really a single concentration risk reduction.
You know what? This is so interesting to me, Scott and Mark, is when people are listening to this, they're thinking of people with tens of millions of dollars.
Mm-hmm. These are,
but they're not.
I put it on folks have $1 million position in Amazon,
right? They're not, and the reality is, look, is not only the financial planning industry progresses and becomes more efficient, it actually will filter down, much like. 10 years ago, you couldn't find a firm that actually provided tax and estate planning.
And it's even more important if you've got, let's say, $1 million or $2 million.
That's right.
Because you're going to be dependent on those dollars for your retirement income.
Oh, it's $1 million out of 1.8.
Yeah.
Yes. If Jeff Bezos' portfolio goes down by 50%,
he's fine.
He's fine.
Right.
His girlfriend might leave him because she looks like that type.
She looks like that type. Scott, you can't say that.
I kind of can.
Is this right?
She's super. She thinks really sweet. I'm sure she's a really nice woman.
Scott, you cannot say that.
Okay, pretend I didn't say it.
Okay. But this goes to say, listen, if you have,
I was kidding.
Yeah, I was going to read a disclaimer, but I don't have it in front of me. But
I was kidding. She's a wonderful lady.
If you're relying on that money to provide cash flow in retirement, it's way more important. So that's why I say there's no hard and fast rule. If you got $5 million in Apple and you got $5 million outside of Apple, and you spend X or whatever, and the $5 million will cover. All right, not as much of a problem. You should probably do something, and we do
because no company lasts forever.
Yeah,
it doesn't.
But let's say I own some PG&E stock for 50 years.
Mm-hmm.
Right?
Yep.
I've got embedded gain in there.
Right.
I would do the same there.
Yeah. Yeah.
Right. And the reality is, as trading costs have come down over the years, it's much, much less expensive than it was 4 or 5
and if
years
you're charitably inclined, of course, you can donate some shares to.
There's all kinds of tax things that you can do.
Like charitable remainder trust.
Right. Yeah. So I think it's working inside a company with a large concentrated position. Sometimes there are restrictions. There are things that you can do to reduce it. Outside, you really have a pretty.
The world is your oyster.
It is, and you structure when you take gains over periods of time. I mean, some people their income goes to zero, and if you're managing the portfolio effectively, capital gains exposure, you can get some out at zero capital gains.
That's so awesome.
Which is crazy.
That's so awesome for rich people.
Yeah. Well,
and go on Obamacare at the same time.
Oh, isn't that crazy?
Yeah. But here's the hard part. Like when you're doing this pre-planning work, say someone has 5 more years at a company, they're like, when are we going to do some tax planning? We're going to do that. And I say, listen, right now you are what's known as a tax taker. There is not a lot, right? You've got RSUs coming and your income and your bonuses. Like you are a tax taker.
Maxing out your 401k, it's about all you can do.
Right. There's not a lot you can do then.
But what you can do is you can do things outside of those company assets and your private assets to tee yourself up for later so that you can have lower tax rates. And those are some of the most enjoyable meetings. We have that first meeting and we run it through our tax analysis and say, yeah, this year your tax rate is 7% federal. They've been at 37 for years.
Yes.
And you're like, huh.
So after they retire.
Yeah.
But this is, I spent last week with a gentleman who works for a large wirehouse.
Old brokerage firm.
Old brokerage firm, right? That they play around the taxing a little bit, right? But I mean,
most of those large firms say we do not provide tax advice. They explicitly state we do not provide tax advice.
But this is value. This is value that's because it's.
Well, it shows those. That's why those studies come out and say working with an advisor,
a good advisor,
you can earn. One study says up to 4%. More.
Yeah.
And you model out. I model out with client, taxes over 5 years. I take a look forward and say, here's what retirement looks like, and here's why we're doing what we're doing.
Yeah.
I mean, I'm talking about Roth conversions when they're 5 years away from retirement. They're not going to do it because I want them to see, here's the look forward. Here's why, this is why we're doing this stuff.
Yeah. Well, good.
Mark, how long have you, so I've known you for 35 years?
I think so, yeah. That's 34, 35, somewhere.
Yeah, someone in there. How long ago did your firm integrate with Allworth? Was it 3 or 4 years?
It'll be 4 years, May 1st. Time flies. Yeah.
Well, thank you for doing it.
Yeah, I'm glad
you've been a
here.
great partner to Allworth,
and the
young advisors love you because you actually stand in front of them and go, "Do this, do the." If you can't tell, Mark is a drummer in a band, and because he's got that kind of energy,
Well, I think one of the unique things about our model is we are actually a team, right? You have your own smaller team, but as far as an organization, we are very collaborative. I mean, when we rebranded from Hanson McLean to Allworth, part of the reason we chose that name is like we are all working together to serve our clients' issues
around all your work.
Yeah. So as opposed to where you've got one person in an office competing with the person next to them, they don't want to share any ideas at all. They're afraid they're going to steal each other's clients. That's not the atmosphere we have here at all.
I lean on people in this firm, old, young, everywhere in between, different
lots of different
expertise. I mean, you can always learn something. So,
and our tax team is
spectacular.
It really is.
Yeah.
Versus 4 or 5 years ago, it is night and day. Anyway, we're promoting our firm right here.
Yeah, so it's coming up on the 4-year anniversary. So you reflect on these things, and for clients, for me personally, for staff in our Walnut Creek office, it's been spectacular.
Well, thank you.
It was a great decision.
I wish it didn't take me 3 years to talk you into joining us.
Me too, Matt.
Yeah. So, Mark,
thanks you.
Thanks for taking some time.
Good to see you.
And what's the name of your band you're in?
Stage Fright.
And if I went to YouTube, could I see it?
Yeah, you can see it, but it's spelled fancy band way. It's Frite at the end, so you don't want to just do it. Yeah, STAGEFRITE.
I don't want people judging Mark based upon his band clips.
I know. Yeah, please don't. They're probably old. We're not.
I've never seen it. I'm going to go home and watch Stage Fright, Frite.
Yeah, we will video this Saturday. We have a gig Saturday, so
okay,
we'll video.
All right.
Thanks,
On
Mark.
that note,
Yeah,
Thank you.
Thanks, guys.